Hello and welcome to the forecast for 2018. Before we begin, there are a few disclaimers that we'd like to go through before we launch into our presentation. Today, we're going to talk about what happened in the financial markets and around the world during 2017. We'll take a look at where we are today, and then we'll discuss where we may be going. Some financial firms believe 2018 will be much like 2017. A year of solid economic growth and strong market performance. There is also a possibility that we could see some significant changes and greater market volatility. Now, as we all know, change is constant. We have seen and will continue to see remarkable changes in our lifetimes. 3D printers are being used today to build buildings and prosthetics. Gene therapy is being used to prevent and cure disease. Lithium is becoming the new gasoline. A fresh race for space is underway. Autonomous cars are expected to revolutionize the auto industry and reshape our world. We can buy wallpaper televisions and a multitude of devices that connect to the Internet of Things. And all of these innovations create opportunities for investors. So let's start with where we've been. Bears weren't happy about it, but throughout 2017, we watched as U.S. indices hit one new high after another. On December 22nd, the Financial Times reported that the S&P 500 had hit new closing highs 62 times during 2017. That was the second most new highs ever. 2017 is tied with 1964 and trails 1995 when we saw 77 new highs. The Dow Jones Industrial Average recorded 70 fresh closing highs in 2017, the most since late 1800s. As we can see from this chart, the Dow Jones Global ex-US Index was up 24.6%. Emerging markets gained 34.4%. Gold finished up 12.1%. The Bloomberg Commodity Index was slightly down at negative 0.7, and the Dow Jones Equity All REIT Total Return Index, that's real estate, was up a bit over 9. All that with the backdrop of the S&P 500 being up 19.4%. Many emerging markets outperformed markets in developed countries as well. In the United States, we saw strong corporate earnings, which helped support share price increases. Earnings were strongest in the energy sector and weakest in telecommunications. It's most important to understand that strong earnings do not always indicate strong share price performance. This chart shows the performance of the S&P 500 by sector. The energy sector had the strongest earnings, but it had some of the weakest performance in 2017. The strongest sectors was information technology. There is a significant performance difference between the various S&P market sectors, but overall, the stock market was very calm during 2017. Markets were incredibly stable last year. The CBOE VIX index, which measures how volatile investors expect the S&P to be over the very short term. A higher VIX means investors expect more volatility. A lower VIX means investors expect less volatility. Before 2017, the VIX had closed below 10 in just 9 separate occasions. Since 2004, the VIX has averaged 18.5. As you can see, it never reached that level in 2017. Investors remain calm and confident for most of the year. In fact, this chart would suggest a slightly bullish slant for most investors. Once again, the bear market in bonds did not arrive in 2017, much as was expected. The yield on 10-year treasuries at the start of the year was 2.45. At the end of the year, they were yielding 2.4, despite the fact that the Federal Reserve was increasing federal funds rate throughout the year. Central banks in many parts of the world had begun to rein in monetary policy. This map is the Council of Foreign Relations Global Monetary Policy Tracker. The CFR compiles data from 54 countries around the world, primarily those with central banks that target inflation, to provide some insight into global trends in monetary policy. Countries that are trying to tighten monetary policy, which is controlling economic growth by raising interest rates, are shown in red. The more a country has raised rates, the darker the shade of red. Countries that are loosening monetary policy, which means they are encouraging economic growth by lowering interest rates, are shown in blue. The deeper the shade of blue, the more aggressively the country is lowering rates. As you can see by the map, the U.S. is somewhat salmon as it's moving toward red. And if you look at Europe, they are still, although a much lighter shade, but they are clearly blue. In fact, you'll notice that some of the northern European countries are a bit darker blue, indicating in some cases their central banks still have negative interest rates. The U.S. Federal Reserve is pursuing less stimulative monetary policy as well. It raised the Fed's fund rate 3 times last year. As quantitative easing, or QE, and other stimulative programs taper off, we may see interest rates move higher still. With that behind us, let's take a look at where we are today. Many people are wondering how long this bull market can last. Some theorize that it can go on for years. Others postulate that it will end sometime in 2018. Before we take a look at what some financial analysts view the markets at, let's take a look at what other deep thinkers are thinking these days. Nobel Prize laureate Robert Shiller wrote the book Irrational Exuberance. He also developed the cyclically adjusted price-to-earnings ratio, or CAPE. The CAPE, or CAPE ratio, is a metric that helps financial professionals evaluate whether a market is overvalued, undervalued, or fairly valued. At the start of 2018, the CAPE ratio was 32.64. Its historic mean was 16.8. In other words, the market appears to be overvalued. When a market is overvalued, it means investors may be paying too much for shares of companies. If investors decide shares are priced too high, they may be unwilling to pay the prices, and share values may fall. However, high valuations don't indicate share prices will move lower. In December of last year, Savita Subramania, head of U.S. Equity and Quantitative Strategy at Bank of America Merrill Lynch Global Research, told Fortune magazine, "It also turns out that valuations are a real lousy market timing model. If you're concerned about what happens over the next 12 months, the amount of returns that are explained by the price-earnings ratio are basically close to zero." No matter what happens to market valuations, we could see a market correction during 2018. Since 2009, global markets have been helped by massive stimulus provided by central banks. As short-term interest rates reached record lows, the U.S. stock market enjoyed its second longest bull market of all times. It has been quite a while since we've experienced a correction, which is a temporary price reversal of 5% or more. Morgan Stanley research found that from 2009 to the start of 2017, there were a number of modest corrections in the S&P 500 index. On average, the market moved down 9.1%, and recovery took 55 days. We did not see a significant correction at all during 2017. Another change that we may see during 2018 is rising inflation. Economic productivity has improved in the U.S. and elsewhere. Economic slack, the difference between what an economy can produce and what it is producing, is tightening. One sign of this is employment. Goldman Sachs reported that the aggregate unemployment rate across advanced economies have fallen almost back to pre-crisis levels. Most developed countries are near full employment, and Goldman believes the United States and the United Kingdom have already moved past full capacity. When slack disappears, inflation tends to increase. Goldman suggests that hasn't happened in the U.S. because of a sizable and relatively long-lasting drag created by weak imports and commodity prices. As this drag disappears, inflation across advanced economies should move higher. Since 1950, stocks have traded at an average price-to-earnings multiple of 18.1, when inflation is between 0 and 2%. When inflation moves higher, the multiple moves lower. However, it's critical to be aware inflation may hurt some industries while helping others. For instance, stocks that are sensitive to rising interest rates, such as utilities and telecommunication companies, may be hurt by higher inflation, while financials, energy, and material companies could be helped by inflation. As inflation moves higher, central banks, like the Federal Reserve, may tighten monetary policy. One responsibility of many central banks is to keep their country's inflation rate near a specific target. In the United States, the Federal Reserve targets 2% inflation. To prevent inflation from rising too high, central banks typically raise short-term lending rates, which push interest rates on loans and bonds higher. Higher interest rates on loans tend to reduce consumer and business demand for loans, which can prevent the economy from overheating. Higher interest rates on bonds would mean the end of the bond bull market. Tax reform remains a wild card for 2018. Congress has passed tax reform and the President signed it into law late 2017. The economic benefit of tax reform over longer terms remains somewhat uncertain. The Chicago Booth School of Management's initiative on Global Market Forum polled a panel of leading economists on the tax reform bill last November. The majority did not believe that a new tax bill would substantially grow U.S. gross domestic product, which is the value of goods and services our country produces each year. The majority also thought the plan will increase U.S. debt. A government's debt to GDP ratio reflects the amount of a country's total gross government debt as a percentage of its GDP. It is used as an indicator of an economy's health. A high debt to GDP ratio may make it more difficult for a country to pay external debts. Tax reform may not give the U.S. economy a big boost, but it may help stock markets over a shorter term. In late 2017, Barron suggested stock investors may benefit over the short term from higher company earnings. Other factors that are likely to affect the performance of companies and industries is the business cycle. A business cycle is simply a period of changing economic activity. One cycle includes a period of economic expansion and a period of economic contraction, also known as a recession. During business cycles, as you can see here, a country's economy grows, peaks, contracts, and then does it all over again. Various sectors of the market may perform well at different points in the business cycle. During periods of expansion, consumer discretionaries, financials, industrials, technology, and real estate may outperform. During periods of recession, sectors covering necessities tend to do well, such as consumer staples, healthcare, telecoms, and utilities. Well, let's take a look at where we may be going. The consensus for 2018 estimates are rosy, but there are risks to any forecast. In fact, Torsten Slok, an economist with Deutsche Bank, has come up with a list of 30 risks to watch for in 2018. I'll share some of those with you in just a moment. First, let's look at expectations for the global economy. The Economist estimated global economic growth will continue in 2018. The pace of growth isn't as fast as many in developed nations would like to see, but growth is better than the alternative. Some emerging economies are expected to grow fast during 2018. The Economist Intelligence Unit List of top 10 economies for growth include Bhutan, Anguilla, India, Cambodia, Bangladesh. Myanmar is also among the top 10 on the list for potentially fastest growing economies for the upcoming year. Growth in China is expected to slow during 2018. Slow for China means 5.8% growth, which is far faster than estimates for many other developed nations. The outlook for growth in Britain and Europe may need to be revised downward. The regions are negotiating Britain's exit from the European Union. So far, talks have not been going well. Some believe Britain should exit without completing negotiations. While governments and economies recover, innovation has continued apace. 5G will make its debut with a showcase at the 2018 Olympics in South Korea. 5G is a new network system that has much faster speeds and capacity as well as lower latency, meaning the network can process a very high volume of data messages with minimal delay. This will all support the Internet of Things. 5G is expected to boost autonomous cars, which will have a profound effect on people, governments, and companies. Last April, an article in the Harvard Business Review stated that artificial intelligence, or AI, is transforming the automobile. In doing so, it will transform much more than that. Given how central automotive transportation is to our cities, commerce, and daily lives, saying that AI will change life as we know it is no understatement. In just a few years, autonomous vehicles may affect infrastructure needs, revenue streams, employment. It'll create new opportunities and challenges. Just imagine a world with no parking fees, parking tickets, parking structures, speeding tickets, or auto liability insurance. If self-driving and driverless autos are electric, the energy industry will change as well. Another change many people agree cannot come quickly enough is improved cyber security. In the past, proving who you were used to be pretty straightforward. Your mother's maiden name was enough. Today, protecting your account and proving who you are has become more challenging because social media and data breaches have made personal data, from credit card numbers to answers to personal questions, much more readily available. Security improvements are in the works. Biometrics, voice, finger, the iris prints are effective personal identifiers. India has become the world's largest domestic biometric identification system. Since 2010, the government has collected fingerprints and iris scans for more than 1 billion residents, and each person has been assigned a 12-digit identification number. Another possibility is a distributed ledger system like blockchain that would have the potential to let individuals control all of their personal information. Until this technology is available, we suggest you use a 14-digit passcode and use biometrics when it is offered as a security option. Markets are facing some risks too next year. There are a variety of factors that can affect it. As I mentioned earlier, Tulskin Slok, an economist with Deutsche Bank, has come up with a list of 30 risks to watch for. I'll share some of these with you. In the U.S., inflation may move higher. The U.S. stock market may experience a correction. Bitcoin could crash. Tensions with North Korea could increase. The Mueller investigation may actually find something. Britain and Europe get quagmired as a result of Brexit, and we might see a hard landing in China. Risks are one reason perpetual bear John Hussman believes the outlooks for stocks and bonds are poor. But not everyone thinks markets have limited potential in 2018. Candace Browning, head of Bank of America's Merrill Lynch Global Research, believes we'll see share prices retreat at some time during 2018, but this should prove to be a buying opportunity. Head U.S. strategist at Goldman Sachs, David Kostin, does not agree. He believes corporate profits are driving the market and the bull market has further to run. Analysts at Schwab believe markets are likely to be more volatile this year than they've been during 2017. Well, we spent a lot of time discussing the outlook for world economies and financial markets. It's just as important, however, for us to know how your lives may be changing in the upcoming year. Maybe there's a marriage ahead or a new grandchild on the way. Maybe an illness is creating unexpected financial issues. Life changes play an important role in determining the financial strategies that'll be right for you. So please let us know what changes may be in store for you this coming year. And as always, we're ready to help you in any way possible. Give us a call, email us, and we're here for you. Thank you.